Hey everybody, it's Aaron with Norris Group. We are trying to do something a little bit different. We're recording this for radio show and podcast later. We've already joined some people who can join us on live. I'm sorry for those who are trying to get in, they can't join us, but we are going to record it and put it online later. And for those later on that are listening to the radio show, you're going to be able to go to thenorrisgroup.com/the number 2 and then spelled out percent. You'll be able to see the video of the entire event, download the newsletter that we're going to go through today, and hopefully this goes off. We're recording in 2 places. Phew, a little stressful. So good morning, or good afternoon.
Good afternoon, Aaron.
First of all, happy 20th anniversary. How does that
Thank you. You know, it's interesting. You think when you've owned a company, you've owned it forever, and yet if it's only the 20th anniversary, I started it when I was 44. So, when you think about that, I guess if somebody asked me, it would have been, oh yeah, I've owned it forever, and I really haven't. That was sort of middle age when I started. So I had to grow a lot in between then. So it's been a really fun journey. But when you buy properties, you can do it alone, and a lot of our clients do that. You basically work at home or you work in a small office. So to have a company with all these different facets to it, that was really outside of the scope for me for the first 15 years.
Wow. Yeah, it's hard to believe 20 years and then 10 years of the radio show this year. We have over 500 radio shows in that hand.
That's interesting. That's another good idea of yours, because it really forced me to study. I interview a lot of these people that are a lot smarter than I am on their subject. So what's neat is we have the history all the way back to the crash. So the opinions before the crash of people that were in the economist world, where I would ask them how they're seeing things. I wasn't trying to trap anybody at all. I was just trying to get their opinion of how they drew conclusions that things were okay.
Yeah.
And that was, it's been a really interesting journey, and a wide variety of people and opinions, so it's been fun.
Yeah, I'm still dealing with a little bit of feedback, and just so you know, for the people who are joining us live, we're recording this for the radio show, so when we're done with this, we're going to dub it over the sound quality of this, and it'll be much better, I promise. Just one of those things we're trying, and hey, if it works, maybe we can do this for other radio shows where subscribers can join us live and ask questions. Technology is So this is your 10th timing report, isn't it?
It is. It's interesting. The first one was 8 years in length. So, the idea of ever doing 10 wouldn't look at the math and think, well, that's likely. But the first one was an 8-year journey, and then when it turned out to be pretty accurate, I started doing them a little bit more often, because there were smaller chunks to consider. When we did the countdown, we did the short-term report until we got to the crash. Crash happened, grew in intensity. We got category 5, which was like, oh my gosh, this is going to get really bad.
Yeah.
So the reports that I'm really, I guess, the most proud of are the cycle changes. So the California countdown, the California comeback, the crash, and even the one in 2012, all in their fold. Those were really good directional get in or get out, and they made people, including myself, a lot of money, and maybe even more importantly, avoided the damage of losing their stuff.
Yeah, I love nothing more than to run into people that I haven't seen in years, and they come up to me and they're just like, I need you to know how much of a difference your dad has made in my family's life, and they sort of go through, and I have a very similar story. I moved back in 2004 from New York City. As a struggling actor, mom was dealing with sickness, and for some reason I just knew it was time to come home. My body fell apart, so the career that I was doing in New York was over, and I didn't even know it, and I got really lucky. And I had, if you've never heard it before, I was working for an architectural lighting designer in downtown LA, and actually absolutely fell in love with the construction industry, urban design, urban development. I was thinking about going back to school for urban development, actually. And I had the opportunity to go back to a Wall Street company, and I was in my 3rd and final interview, but it was a surprise interview that took a very strange turn, because it was going to be somebody that wasn't my boss. It was just somebody who wanted to call me in to let me know that she was really the boss and not to cross her. I was complaining to you. I'm like, oh my gosh, this is going to be an absolute nightmare. What did I just sign on for? And it was right before you decided working on the California crash. And you said, come work for me. I was like, let's do it. And it's been a fun ride. So this is going on my 12th year at Norris Group.
Best moment for me in creating of these reports is in the audience, as the audience was coming in for the California crash, and we had created a very rudimentary document for California comeback, a little better document for countdown, but you got a hold of the crash. And when people opened that document, it was fun because there were audible gasps that, oh my gosh, look at this thing. And so that's been true ever since. So yes, it's been, thank you for helping create what I consider a pretty cool legacy or journey of saying this is what's next.
Very cool. Yeah, it's just been such a fun ride. Well, we have a lot to cover today, so maybe we can dig in, and thanks everyone for joining us live, and so sorry for those who just got blocked. It'll be available afterwards. So
yeah, it'll be recorded. We're going to do two segments today. We're going to do a review of the newsletter, and then the second segment we're going to take a look at the table of contents for the new report. I know I've done my job when I'm trying to do a report and the ending surprises me. That's a fun ending for me, and that really happened this time. So the process when you're doing a study of what's next goes, first thing is you do all of your research. It even means that you eliminate many chapters that you have written on before. So it's like an NCAA tournament for me. I lay out the 60 or 70 folders on reports, on chapters that I've done in different reports, and then I go through a contest to see which 20 survive the cut, because it's about all I can do in that day. And so the next segment will talk about the 20 that survived the cut and why this time they were maybe more significant than the ones that didn't make it. So you do all this research, and then right at the end you draw the conclusions. And the process is actually very similar as doing an appraisal on a property. One of the big mistakes investors make is they want a number to be true. So they buy a property and they look for the highest comp, and it doesn't matter if it's 1,000 square foot smaller, 50 years older, in a bad area. It's just the number they want to reach. And if you do reports that way, you'll find the information that'll prove something, but it won't be the right thing. So you can know that every time that I've done these, I've literally cleaned the slate. I challenge every conclusion I've ever made, and then I do new research. I've been researching this for 6 months, and I didn't write the final chapter until within 10 days ago. And this final chapter is the largest final chapter we've ever had. It comprises nearly a quarter of the book. And the reason that is there's a process that I have to take you through to show you the reasoning and the rationale why the conclusion this time is different than any conclusion we've had in the last 40 years. And so for me, that was really important. So it projects out 10 years from now. Probably means I won't be doing another report during the next 10 years in California. It doesn't mean that I won't take a look at another area to see if I can figure it out. And I won't assume that the other area is at all similar to California. So I still may have my fun looking at another state. In this quarter's newsletter, one of the things that we did is we snuck in a chapter that I didn't think I would have enough time to cover during the seminar day. And some of these 5 topics that we're going to cover right now really deserve a chapter of their own. Unfortunately, I'm not knowledgeable enough to do that chapter, and I realize that. And, when I realized that, I thought it would be fair just to put a title. So the wildcard chapter literally just has 10 subject titles, and we'll cover half of them in this newsletter, and maybe in another newsletter we'll do the other half. But these are subjects that could affect California real estate, but aren't connected to the real estate world. Sometimes they're not even in our country, but we have to look outside that sometimes and say, okay, if this goes wrong or this area has a problem, it could affect what happens to California prices. And the first wild card I'm going to talk about is China. And I was going to write an entire chapter on the subject, but I realized I couldn't do it justice. I wasn't familiar with it, and so I decided to be honest with myself. China's the second largest economy in the world, and so if they have any major problem, it'll be felt worldwide, affect the economy of a lot of areas, not just their own. Since the financial crisis, and there's a chart showing China's national debt, it's exploded from 158% in GDP to 282%. And a lot of that debt is due to very aggressive expansion of real estate. About 40 to 45% of China's debt is connected to real estate. And the personal debt owned by people that own real estate has gone from half a trillion to 1.8 trillion in 7 years. So it's gone up by over 3 times. The day I realized that I wasn't really going to be capable of writing a chapter on China, I watched a half-hour segment, a documentary on ghost cities of China. And when I watched that, I realized, okay, I have really no idea how to comprehend what this means. What China has done is they built cities in their entirety that are going to be occupied, hopefully, within the next 20 years. So think about, and this isn't a city like the city of Riverside, for instance. It looks more like Manhattan, and they've got a lot of these cities that have been pre-built. High-rise condos going for $500,000, median income of the area, $4,000 a year. When I heard that statement, I just realized I have no idea how to comprehend what the thinking was behind that and how much value is really in that high-rise condo. How do you have a $500,000 condo when you have $4,000 median income? I'd like to give that one to Rick Solis. Please appraise this condo. Tell me what it's worth, since it can't produce a cash flow past probably $1,000 a year. So China's built these cities in advance, and if you think about how many they've done, a lot of their GDP growth has been attached to this type of project. 30% of their GDP approximately is connected to real estate. And what if you don't need any future cities going out 20 years? You're having trouble filling the ones. So I don't know what's going to happen to their economy, but it feels uncomfortable. Most of those buildings are owned by people that are speculative people that own with the intent of making a profit. And the debt attached to it, I just don't know how to calculate that. If I was a hard money lender in China and somebody came to me and said, I just paid $500,000 for this condo, and I took a look at the likely income from rental, I wouldn't know how to make a loan for them. And so I don't know how to value what they've got. The other thing is there's a lot of money that's leaving China. So you've got people with money, and there was a talk I did in LA, and there was a guy that was a Chinese citizen there, very helpful, very knowledgeable, connected to investments, and he was explaining some of the things. There's people with wealth are very uncomfortable keeping it there. They're afraid that the rules of engagement could change, that they may not be able to sell their asset, they may not be able to get money out of the country, and so you're seeing money come out of China, and it's because the people that have the money are concerned. The other thing that really bothered me, again, another documentary, was I was watching a healthcare documentary, and their system has a lot of problems. China's definitely an area that has grown and has tremendous wealth, but you have a lot of people that are living in very rural settings with no income. And their healthcare system is basically a pay-as-you-go system. So you go in there, you get a number, you actually pay for the number, you wait for your turn. The doctor sees approximately 100 people a day, so however many minutes that gives you, that's how many minutes you've got. If you need a procedure, you have to pay for it usually up front, and then if insurance kicks in and rebates you something, that's what happens. And there was this one particular man that had gone in there with tremendous pain in his leg, and it turned out he had a blood clot, and he had about 10 days to live, they said. The surgery would cost $50,000. He was a farmer that made $4,000 a year, and somehow he had managed to save 30 grand, and he was, this was for his entire life. And so he couldn't have the surgery, so he went home. They gave him painkillers so he would be not miserable until he died. And he decided he would take matters into his own hand, and he cut his leg off with a hacksaw. The local people heard about that, and there became a problem. And so the government came in and actually offered to, his other leg got infected, so they offered to take his other leg off for free. And that's what we saw, was this guy talking in a wheelchair. So I don't really know how to appraise China's issues going forward. I can just say that I think there's going to be some uncomfortable times for them. They're a great growth story, but for many people who still live in the $4,000 a year income world, life's been very different. So China could have a lot of challenges, and if they do, because of their size, it's going to affect the world economy. The second surprise or wild card, thank you, Aaron, is the Eurozone deflation or breakup. So you have Brexit that's coming along, and there's a chart that shows what that means to the economy. There's a 5-year projection there where the EU, the European Union, loses GDP for the next, from 2018 to 2023, and even a bigger piece of loss for the United Kingdom. So that's a recession in the EU for 5 years, just with that event happening. And the EU's economy is maybe a little bigger than the United States if you take a look at the whole. They haven't been growing at a tremendous rate up until now. They came off of a recession, and now we're probably headed back there. The other big wild card for the Eurozone is the upcoming elections. You've got major elections in Italy, France, and Germany, and depending on how those elections go, you could have a very different looking Eurozone after those elections in 2017. I'm going to read part of the newsletter. It's a Reuters article, November 16th, 2016. Elections in France, Germany, and Netherlands next year, as well as next month's Italian constitutional referendum, are flashpoints that could ignite brewing political discontent across the continent. These are among the biggest risks for 2017, and I'll let you finish reading that, but that's an important part of what's next for that large group of countries that are joined together. And there's another article that, and this is from the John Malden's newsletter, and it's from a Financial Times columnist, Wolfgang Munchau, I guess, and I'll just read part of this, and this is another warning. One day Italy will be led by a party in favor of withdrawal from the euro. When that happens, euro exit would turn into a self-fulfilling prophecy. There would be run on Italy's banks and its government bonds. And then at the very end of that, it says, the latter would imply the biggest default in history. The German banking system would be in danger of collapsing. The Europe's biggest economy would lose all of its competitive gains so painstakingly accumulated over the past 15 years. So we have to keep an eye on what's going on over there for 2017, because it could spill over into the world economy and become a big problem for the U.S. and the growth. The next topic is oil disruption. This is an interesting topic. We have a president that has decided to get aggressive with the United States capacity maybe to be oil independent. Just signed today legislation for the Keystone and Dakota Access pipelines. There's a chart in the newsletter that shows the percentage of GDP that oil is responsible for. And it is so lopsided, it's scary. In Grand Junction, Colorado, I made an investment there because oil shale went bad in Grand Junction, and you had a city that was 50% vacant for maybe 5 to 6 years. You have countries that have oil be a very large percentage of their GDP, and if they're unable to continue producing oil at a profit, or their supply isn't needed by the United States, that's going to be a really big problem for their economy. They're very unstable as it is, and there's an article that I quoted there, and it just talks about that this is a very unstable region, and it doesn't need any help to have become more unstable, but that's probably going to occur. The other thing that could really affect this is a chapter that Aaron is going to be covering in the next in the report, and it has to do with just the progression of the electric car, solar power, and how that could disrupt an industry that we think is just irreplaceable at the moment, but it might become less and less necessary. So that's a big deal, taking a look at oil and this area that can be very volatile as it is. If it has a real problem with oil, look at the red. That's the part of the economy, I think, that's oil connected. Tan. Okay, so tan. So it varies. I mean, you have it from, say, 25% to sometimes 60, 70%. At any rate, even if it's 25%, if you have a real problem in that area, you have a real problem with unemployment, and you have a lot of problems with your society in an area that doesn't need any help with that. So that's a wild card that I will take a look at and see if it's going to be disruptive, if it's going to be violent, and if that's going to visit us somehow. Another wild card is the tax law changes. So we have a president that's definitely going to change the tax laws. You're going to have what's probably going to emerge as a much larger standard deduction. So you're going to get about a $30,000 standard deduction, which is approaching triple what it is right now. It will mean that 60% of the people that file long form will no longer need to file long form. And that will be one of the reasons why it'd be so easy to say we're not going to allow for interest payments to be deductible off of your income tax anymore, because it will hurt so few people. So I really expect that to happen, and it'll probably be virtually harmless for the next cycle if interest rates stay low. It'll hurt when interest rates go back up, but I think that's coming. It's probably another law change that could happen, is you could have a change in the $500,000 IRS 121 law that says you can make $500,000 on a sale of your residence every 2 years. That one always kind of cracked me up, to be honest with you. So I mean, I'm excited about that being there. I took advantage of it once, but it wouldn't surprise me for that to go. Lastly, the healthcare laws, they're about to change, but we have to be really careful that we don't say, okay, well, everybody with a pre-existing condition or people that are too poor to pay for coverage are left out. So it's going to be a challenge. This is not going to be an easy turnaround, but the increases that we see by this map of Obamacare, there's been a lot of increases in rates, and this system isn't working, so we have to figure out what's going to work. The truth is 10% of our population, there's a chart that shows that 10% of our population accounts for 66% of healthcare expenditures, and 50% of our people account for 3%. So it's definitely lopsided. One of the reasons it's lopsided is you have an aging population. So you have charts that show how different the cost is per capita, an annual expense. So you get over 85, I mean, you're spending a ton on healthcare, and it's basically halved between every 20 years. It basically, if you go the other way, it basically doubles as you go and get older and older. So that's an inevitability. We're going to have an aging population, and we're going to progressively get to live longer. So this healthcare issue is a big deal. And the other thing that I'm kind of surprised at, that it doesn't affect your ability to get a home loan, because all of us have experienced how expensive it is to get insurance, and the deductibles are growing, but it's not an equation that comes into play when you get a home loan, and eventually it may. So that could impact real estate as well. Time-wise, what are we doing here?
We have about 25 minutes for the radio show, but we can cut some things out later on if we need to tighten it up, so we can go the full amount.
I don't know how much time do we have left is what I'm asking.
25 minutes.
Oh, no, for the next.
Oh, yeah. We're already in our next show.
Okay. All right. If you look at the county by county, and I don't have to do this blow by blow because I do want to spend a little time on the other chapter, or uncovering the chapters, there's just no significant changes that happen quarterly for California. You have areas that are in the same boat they were the quarter before. You have some areas that are pushing their limits. The two that come in mind: Northern California, San Francisco, and trying to think of the other one. But anyway,
you might want to go through this, because for the people who are listening for the first time, they might not know what this is saying.
Okay. I have to find my notes on that. There we go. Okay, so the first county, Orange County, I'm just going to do this pretty quick. Prices have been pretty flat for the last 8 months. If interest rates were to change, the way we calculated this, by the way, is we took a look at where we were at the peak in 2005, and that was where I considered the real peak should have been. The peak price should have ended there. It didn't. It ended a year and a half later, sometime in probably 2017, but that was just due to financing that will never be replicated. So we did a mathematical equation and create a monthly payment that's likely the ending point for each of these counties. So Orange County, we got to a payment of $32.99, and calculated from there where we are in price and what interest rates could go to, and how that changed the payment and the ability for this county to go up. So right now, if you have a 4% interest rate in Orange County, looks like you have still a 17.6% upside. If interest rates went up to 5%, that would be cut way back to 4.6. So this is one of those counties that's really going to be sensitive to interest rate changes going forward. Riverside County is another county that is one of the counties that isn't quite as sensitive. So you've got prices being flat. You might go to the chart and then come back. Okay. There you go. So Riverside price has been pretty flat in the last 9 months. Gone up well year over year, but then it's flattened out. So it's hard to say what's going to happen with that next. But if we take a look at where we are in relationship to a max payment, looks like we have still a lot of room. If you went to a 4% interest rate, which we're at now approximately, you still have a 36% upside from last time to get to that 1842 payment. And if it even went up to 5%, we'd still have over 21% upside. So Riverside County is one of those counties that has an upside even if interest rates go up. Sacramento is almost a duplicate of Riverside. In Sacramento, we've had gradually rising prices over the last year. Nothing spectacular, but it's been consistent. But there you have the capacity for the price to still go up at 4% interest, going off of what looks like to be possible a 1750 payment. You're still 41% upside. At 5%, you're 25% upside. So this is one of the counties that has the largest upside potential still to come. San Bernardino, prices gradually rose all year. We have some people that have gotten rid of their pile of rentals in San Bernardino, probably early price-wise, but probably a relief not to have them. Sometimes the counties that are the lowest price are the most challenging places to have rentals. But anyway, if the goal payment was $14.32, with an interest rate of 4%, we still have a whopping 48% upside in San Bernardino. If it went to 5%, upside of 31%. San Diego, price is pretty flat for the last 9 months. This is a county that's a little bit mimics Orange County, so if you had an interest rate that was 4%, which is what it is today, you still have an upside of 32%. 5% interest rates takes it down to 17.4. LA, if you look at the price chart, November 2016 price pretty close to 2015 price. Gradual increases all year, and then 2 months of decline gave most of it back. So, you know, that's the thing about it. It's hard to read anything permanent into a 2-month decline. The overall math is that LA County is at 4%. It's got some upside of 23%, under 10% if it gets to 5% interest rate. Again, these are all calculated on the max payment that we thought was possible for those areas. Santa Clara. This is an area that's kind of been flat over the last 9 months. Certainly had a very healthy price increase at an interest rate of 4%. It looks like only a 6% increase is possible, and if it goes to 5%, you're in a negative territory. So to me, this is a speculative area. Doesn't mean you can't make money in the area, but you have to recognize this is no longer investing. This is speculating. Same is true in San Francisco, maybe more so. So you have fairly flat prices, and now you're already in negative territory at 4% interest, and a much more negative territory at 5% interest. So this is an area that's already exceeded way beyond the peak. Last time the peak price, 972, and we're at 1,360,000. So there's reasons for this area to have done very well. They're doing a lot of new construction and doing a lot of revitalizing. You're taking down old apartment buildings, building high-rise expensive condos. The rents have exploded. So there's reasons why these areas are doing really well. It doesn't mean that they aren't maxed in price. It doesn't mean they couldn't have a downturn. Kern County, we really didn't play with this one as much, but Kern County has had just really a mild price projection over the last couple of years. It's a progression. It looks like it still has plenty of upside. You know, whether it's going to get there or not, probably pretty doubtful at this point. So it has lots of upside to get to the past payment, but that was really driven by a pretty insane market, and it's pretty rural, so don't know that it's going to have its turn this time. Fresno, same kind of thing, same kind of upside, gradual increases, but don't see any miracles happening in Fresno either. If we have any questions,
yeah,
I'd be happy to.
We'll definitely start taking those live now. Let's maybe take questions on the newsletter itself before we get into the table of contents. So Bruce, yes, what happened to San Mateo County?
Sorry.
Yeah, it's just difficult to do every single county. We try to cover some of the most populous, and we don't get to all of them. So yeah, we got similar. Josh, sorry, Ventura County, we didn't cover as well. We did add Fresno, though, in the last year.
We do have it in the report. I know we have Intere in the report talking about all those things, and I don't know about San Mateo, but I know Intere.
Yeah, I agree. All right. Do you have any other off-the-cuff thoughts about Ventura? Josh wants to know.
Josh, I got it in front of me. I don't feel there's many areas that are completely maxed out in price.
And I guess that's when we talk about what's next about 10 days from now.
The least important thing will be the short term, which means in the next year. What will be important is the decade that follows, because there'll be game-changing events that just make the outcome different. So if you're asking me, do I feel an urgent thing to sell something in Ventura at the beginning of 2017, the answer would be no.
Okay, we got another one. How does U.S. dollar devaluation factor into your use of a statistic payment price in your analysis?
Generally, it doesn't. So you're talking about maybe how it affects more the foreign investor coming in. And in that case, do I consider it? I do consider it. Have I calculated the difference? One of the reasons why I'd have to say that I haven't is because I can't find it being important enough for its own category. And that happens sometimes. And I'll give you another relationship that you think, okay, well, how come this isn't here? How about rent price to payment price? The ratio of there, certainly that must be important, except for when you do history of it, you go, well, it's not. So if it's, San Francisco would be a perfect example. It's the most out of control ratio there could be, even though the rents were high, the payment's enormous, and year over year, they went up 25% when that ratio existed, the price. So there's some categories that seems like, okay, well, that's an important one. It might be important to somebody in China who's having their currency devalued, coming and trying to park their money in a dollar, okay, based asset. That would make perfect sense. It would make perfect sense if you were in Europe and the euro and the pound were devalued, that you would buy less U.S. real estate. That would make sense to me too. But is it the quantity that's going to tip us over? Probably not.
So Corey's asking, so you are saying that Sacramento County still has room to go up?
Yeah, I mean, that's why we do the math. I mean, that's the thing. There's nothing in Sacramento, Riverside, San Bernardino that scares me. You just, when we cover that area in the report, you know, we have to look at that and say, okay, well, why didn't they join the party? The second chapter in the report deals with, or the first one actually, 20 appraised properties. So Rick Solis has over and over and over again appraised the same properties, and they, you know, they don't touch all the areas, but it's interesting that you have areas that have gone up way past their peak in 2007, and you have areas like Sacramento, San Bernardino, Riverside that are way, way below. And that dichotomy has really not usually existed to this extent. So you usually have high dollar price property go up first, then the money flows out to, you know, let's say from Orange County to Riverside, from Riverside to Victorville, from Victorville to Barstow. That's the progression as money tries to find some kind of sensible price on something to get a yield. We just didn't get our share of it this time in those other counties. So that's part of, you know, what do we have to look at going forward? What was missing? And it's going to correct itself. And to me, that's part of the story, because the answer is probably no.
I'm going to combine the next question sort of two. One is sort of talking about the dollar then versus now. Is that sort of calculated into the affordability index that we're looking? Is, you know, if inflation is, you know, a dollar from 10 years ago, is it worth the same dollar amount today as we're sort of calculating affordability?
Affordability, I just take what California Association of Realtors spits out. I don't think it is attached to anything other than what it is today. So it calculates what percentage of the households can get a yes answer from a lender, given the fact that they're putting 20% down on the median price. You end up with a loan balance, and you apply the interest rate, and you look at the income, and you get a percentage. What's fantastic about this chart, it's inaccurate 100% of the time, and yet it has been the most accurate projection for a downturn that I can find. And to me, it's interesting, because you can make the case, well, not everybody puts 20% down, and you're absolutely right. It's never true. Isn't that interesting that a chart that is completely flawed can be such an accurate projection? And by the way, I am not stuck on any chart. All it does for me is give me a better conclusion. If I found one that was better, man, I'd use it. And I spend a lot of time in this report, and that's the second chapter on affordability, because there's a lot of people that are pretty intelligent that I respect that really disagree with this. So this time I really went and did a progression of, okay, when this happens, there's a reaction, and I do it over and over and over and over again. And you can tell me at the end of the day which chart told you what was next. And you can disagree with it if you want, but I don't care about what chart it is. I care about avoiding damage. If you find a better chart to help me avoid damage, I'll pay attention to it.
David wants to know about Las Vegas. Any thoughts?
You know, I'm not an expert on anything outside of California, so I hesitate to make a statement. I think Vegas bothers me a great deal. It's one industry that if you were a terrorist, honestly, that would be a place you could damage. You could damage really bad. I would be concerned about that wild card, but also it's the phoniest market that has existed. The foreclosures that could have existed in Vegas completely never happened. They basically passed a law that says you're going to have a very hard time foreclosing, so they didn't. Well, they created a housing shortage, so you actually have a building boom in Vegas while you had 50% of the people upside down, and since they weren't foreclosed on, you didn't have a big ratio of foreclosures. So you literally ended up with a building boom because you had a housing shortage that was completely nonsense. So do I trust that? I don't, to be quite honest with you. And that doesn't mean I'm right or wrong. I'm just telling you what I view that as this very speculative area, maybe even because the first reason bothers me more than anything is that you could have a terrorist event, hit a hotel, and you could find all the reason in the world to go gambling in Temecula instead of Vegas.
Yeah, true. I'm sure the Indian casinos would love that. Ollie wants to know, so would you be able to conclude that in the San Francisco Bay Area that it's peaked and should probably sell and buy into these other counties you charted for upside? That's a good question.
You know, it is a good question. The hard thing about a speculative area is that the human being will keep on investing in stuff until it goes down. And so can I tell you that it's peaked? I can't. It's like telling you Bitcoins have peaked or, you know, whatever else the crazy things go on. It's overpriced compared to anything in its history. To me, that's a speculation. So you really have to decide, if you're in Sacramento, you're an investor. If you're in San Francisco, you're a speculator. Could the speculator make more money? Absolutely, until they don't.
And that's the danger.
Right, we had a few questions sort of along similar lines about specific areas like San Diego. So you're saying, you know, we're butting up against that peak. And I like that you were very conservative looking at going back a year before the lending got really crazy. So we're looking at 05, the payment in 05 before the nonsense loans got us to blow through that. So it's a rather conservative chart, which is good.
Yeah, it is a conservative chart, but it's probably more accurate than the other. So I think it's, if you think about it, we're still not there price-wise either. As a median price, well, maybe we are getting close to it. But San Diego, if you're asking me, okay, do I feel an urgency to sell something I have in San Diego in the early part of 2017? No, I don't. Okay, we didn't say that the upside was zero or negative or it was speculative. It's within 20% at 4% interest. What would be really interesting is to see where interest rates go. And that's one of the reasons why I covered the wild cards, is if some of that materializes in 2017, you know, we cover this really well in the report, is how that could filter into our economy. And if it filters into our economy and creates a recession, what will happen to our interest rates?
We got a question about your rentals. I've gotten a lot of questions about that. Did you sell everything? You're leaving California. What's going on?
I have virtually sold everything that I have as a rental. Not quite, but so it's a fair question. The reason I did that is it just made sense. I bought them for, one of them, I'll give you an example, $64,000. I fixed it. I sold it for $275,000. I was able to do a 1031 exchange and end up with two brand new houses in a great area for twice the rent. I mean, that makes sense. It happens to be in Florida. I have my best friend in Florida. I'm comfortable with all the demographics about that. So that's why it made sense. Well, did I sell because I thought it was maxed out in Moreno Valley? No. I wasn't afraid of that. I was just being a good investor. I was returning to my investor roots and saying, okay, I want to hold those long term. Did I want to hold the Moreno Valley property long term? No. I bought it with the assignment grow in price, and it did. It went up three times or more. So that's to me why I sold it. I haven't stopped speculating. I just started building. I don't know. I think we built 4 or 5 houses this year, and we're building already 4 or 5 new ones that just haven't even come out of the ground yet. So I'm not afraid of this area. That's just so you know. I mean, again, what's going to happen in the next 12 months to me is insignificant as to what happens in the next 10 years. That's a much more important question that will take me a while to explain.
Okay, we need to move on. We can come back to questions, but I've sort of got to keep an eye on what this will look like on the radio show. So let's get to the table of contents for the report, talk about each of the chapters, why it's there, and this really helps people who've never been to a timing event with us sort of what to expect. So I'm skipping the introduction, but chapter number 1, 20 appraised property. What's that about?
Yeah, we briefly mentioned that. Rick Solis over the years has appraised properties for us, and we have 20 properties that just like say 1 in Riverside, 1 in San Bernardino, 1 in Victorville, etc., and probably appraised it from the peak in 06 or 07 and just did it a few years, every few years. So we have this little trail of what it was worth in 07, 09, 2012, and 2016, and maybe another year in between. And what's revealing about this is how different this comeback is. You don't normally have an area still half of what it's valued when you have another area that's 50 miles away at over 100% of where it was in the last boom. So that to me is interesting. It does tell me that there's a chance to be an investor in some of these areas. And in the report, in another chapter, we talk about why that happened. Now, I want to mention something, and this is not how we normally think in California. In the 70s, early 70s, California in the United States was almost exactly the same median price. About 32, 34 grand. That was the big spread. And then all of a sudden California went crazy and went up to double, and then to 250% of it. Okay, here's a good question. Well, what if the stuff that made that happen are not going to be present in the next decade? Okay. And that's what this report deals with, is that, okay, are the elements that made that all happen still existing? And if they're not, why would we be capable of keeping that ratio? And that's why that chapter is so long, is because I'm going to methodically go through 24 reasons why this outcome will be different. Doesn't mean, by the way, that I won't participate in California real estate. I'm just going to understand that the game is different this cycle.
Understood. Okay, chapter 2, affordability, one of your favorites.
Yeah. The only reason it's one of my favorites, it's just, it was one of those aha moments. I remember looking at it and going, oh my gosh, that is, when that tilts over, there's a lot of problems that happens. And that's all it did for me. It was a warning light. And okay, what does affordability mean? It means the ratio of people that can get a yes answer from the lender. So when that gets too low, doesn't that make perfect sense that would have ramifications on other charts? Yeah. I get that. So what happens to affordability, it's usually looked at the opposite way. So high affordability, that means wonderful things. Well, no, it never does. It always coincides with a billion REOs. Now, it's great for our industry because we know how to deal with that. So I look at charts probably in a reverse order than somebody that's got a PhD in economics and says, or has a, high affordability means everybody can buy. The problem is that they don't buy when affordability is high. They're scared to death. And so, but this time we really do tear apart affordability and watch the progression happen. And I ask the question, basically, is this chart an initiation of something else, or is this like all-inclusive in its own? And it'll be fun to go through all that because it's the first time I've actually taken that helping land on affordability being the most important chart
to determine a downturn.
Okay, sales and inventory, chapter 3.
Very important. That's the thing. Most of the categories, by the way, we kind of rate these 1 through 5, and a lot of these 20 chapters land in the 5 category as really important because if they get skewed one way or another, it can be a big deal. So sales and inventory, the mix of inventory, you've got tremendous upsides, in sometimes when you have downturns. Let's say you have a large buildup of foreclosures and your inventory changes in nature. And this takes a really good look at that and what the numbers are as far as, okay, when you're into dangerous points. Our sales really have mimicked something that is very unusual. The last 5 or 6 years in sales for California, while prices have doubled, have almost exactly mimicked the years 90 to 96 when prices went down 20% in California. That's what our sales have done. So here we've had this boom in prices only because we crashed. So it's kind of a weird doubling. Yeah, we gave up 55% to double. So we're really where we were before, somewhat less. But our sales are just not going anywhere. And so then you have to go, well, why is that? Is it going to change? And if it isn't going to change, then what's the future of our pricing power, okay? Because if you don't have a big pile of sales, it's really hard to push people into unreasonable prices.
All right, lending.
Lending, big issue. Is it going to get aggressive? Is it going to really produce the buyer that's at the margin a lot of times to where we can get a lot of volume? Dodd-Frank, maybe it's going to be repealed, but I think you have lenders getting fined all the time. So I don't know how aggressive they're going to be in the short run. Interest rates, that's a wild card. And for me, this report doesn't attempt to project that as much as it does just take into account if it's 3%, it's this. There's a really interesting progression that we do at the very beginning of that chapter. And it basically is a journey for my life. 17.5% interest at $100,000. What's your payment? Okay. The same payment emerges at $350 at 2.5. So that's how important that answer is, but who knows what it's going to be. Next is employment. So you've got pockets of employment that are doing great in Northern California, and you've got construction employment virtually not showed up in Riverside, Sacramento, all those areas, okay? Aaron's got a real important chapter in this report, and it's going to talk about how things might change in the next 10 years, about how you're employed and if you're going to be replaced by something called a robot. Trustee sales, again, I look at all the ratios of the past and say, okay, how could you have 3 downturns and yet you have one in the 80s, or early 80s, no price hit, 90s, 20% price hit, and in 2008, 9, and 10, 50% price hit. What was the difference? And we find the difference is in the ratio of trustee sales to sales, and then we'll project what we think is going to happen with that going forward. Construction and commercial. Construction hasn't done very much. We almost missed this cycle for single-family homes. They, in the commercial side, though, built a lot of apartment buildings. Commercial real estate is about 126% of the peak. So overall, it's much stronger. That breaks into some categories that have gone crazy. Storage units have gone up 180% if you own not an apartment, but if you own a hotel, Airbnb has kicked your butt and it's gone down. So it's not an even-sum game. The question is, are the cap rates that people are paying really creating a value for them, or are they going to be, if you have interest rates go up, is that going to be a big negative? Retired readiness, just looking at the people that are retiring, their net worth, how much problem that could be going forward, and how unlikely it is you're going to take anything away from this group. Demographics and migration, just showing that we're definitely going to have this great group of people turn over 65 and all the things that matter math-wise to that. The next 2 chapters, pension math and national debt. this is, after I look at this chapter, I changed the chapter title or the title report from 30 trillion to 40 trillion, because to me it looked like we were probably going to do that. And one of the reasons is the presidency and past financial outcomes. So we took a look at when a Republican president comes into office, what do? Well, he's role-playing. He's doing it just the way to do. Let's cut taxes. Well, that's great. It's going to create less revenue, so that the bill will go up as far as deficit, where we do something smart with it, and we're going to have a lot of infrastructure spending. So all of those things come into play with saying, okay, could you have a $40 trillion deficit and things be okay? Yeah, you could. If you just spend the money on the right things that create a future profit for infrastructure, that makes sense. Already talked about oil a little bit. Aaron's going to take the chapter on changes due to technology, and that's a chapter that's over my head. So I'm glad he's doing it. And then rentals, and at the end we'll talk about where we end, where we are and how we end. And that is a lengthy chapter of about 50 pages. And at least you'll feel like, okay, I've explained to you where I landed and why I felt it was comfortable to say 10 years out, here's where we'll be. The last chapter, top timing takeaways. So 30 tips and aha moments over the last 20 years for me.
We ended just in time, which is great. We'll continue with the questions, but we needed to tighten that up to make sure we could fit this on the radio show. So we're going to go back to the questions. If you want to see the newsletter with all the charts, because we flew through some of those, especially by the county, just go to the norrisgroup.com/2 and then %, all one word with 2%, and you can find that. Okay, leverage. As you change your rentals in California to Florida or based on the market conditions, do you recommend using leverage?
Personally, I'm 64 years old. I virtually have no leverage, but that's just because I don't care to have it. I don't say, okay, gosh, I could get twice as many or 4 times as many. Would I use leverage? I would use intelligent leverage to make sure that I don't have a problem with payments in almost any case. One of the things that we've spent some time this year on is going back to Washington, D.C. twice, and so I really think there's going to be a new attitude toward investors, because it is going to be the main growth area for housing. So if you're a lender, you might want to get good programs with fixed financing for investors. So I do think that's coming within 2 years. I think Fannie Mae will open up the doors. Instead of 4 properties or 10 properties, it will be a number much different.
We have quite a few questions that we might be able to hit all at once on rental markets, from San Francisco to, what are you thinking rents are going to do?
What do I think rents are going to do? I think there's going to be more demand for rentals than there is going to be for occupant owners. So it really will depend. I think we're in for a recession in a couple of years, inside of a couple of years. So generally what happens is you lose migration in any of the areas in California. Sometimes it's less severe than others, but it's a little hard to have rental increases while you're losing people. I don't know that I would count on a lot of increases going forward. There's a point where you just, okay, that's it, especially if you have migration loss. So, and some of the prices, if you're going into a rental market, I can't imagine wanting to be, my first investment being in San Francisco, even though I could rent a 2-bedroom condo for $5,000, I wouldn't want to pay $2 million for it and have that make sense. So there's a point where you just go, okay, well, I really don't think I'll start here. I don't know if that helped. I just don't see rents being really aggressive for the next couple years, but they've really been aggressive. All the charts in the rental chapter show that we've had some pretty healthy gains. Some areas, just ridiculous gains.
Okay, you know what? Actually, we hit the hour mark, and we definitely need to wind it up today.
Okay.
What we promised. For more information on our upcoming event, February 4th, we just have a handful of tickets remaining. And thanks for everybody for coming out. It's a lot of fun, and always attracts a very interesting crowd. So we're going to have 435 people there. We'll send out an email if you still want to report on how to get that and how we're going to end up doing a waiting list. this to be fair. We've only printed a certain amount because these are really expensive to produce. A custom binder, 250 pages, 400 charts, it sure takes a lot of work. So it's been fun to produce, but I'm glad it's at the Printer Academy, honestly.
Me too. We have gone through this over and over and over again to try to make it perfect. So.
All right. Well, thanks so much, everybody. Go to thenorrisgroup.com/2% for more information, and I will place this entire video there. Thank you so much for joining us for lunch today, and hopefully we'll see you February 4th.
Thank you. Untitled video.
Yeah.
Or video?
Yeah, we videoed this.